Hey, this is Nick from Income Digs, and today we are talking about the BRRR strategy, a really popular and a really amazing strategy for long-term real estate investing. I'm going to show you how to properly add the BRRR strategy properties into your QuickBooks Online account, doing it the right way. We're going to start today with the purchase of property. Before we get into it, I do have a question for you. Do you have a process? Do you have a system for managing your books, your bookkeeping for your real estate investing business, for your building business? If not, you need to check out my end-to-end course, Real Estate Accounting Bootcamp. We go through everything, my entire system. I want you to check that out for sure. But let's get into it today with the BRRR strategy. Again, this strategy is super popular. What is it? What is this BRRR strategy? Well, it starts with buying. We buy a property and then we renovate the property. We're adding some kind of value to it, and then we are renting the property out. We're finding tenants and renting it. We're getting the financials working, and then we refinance. And it's an amazing strategy for getting into a property, renovating, refinancing, and then holding on to it, using the cash from that refinance to potentially do it again with another. That's what a lot of people will do, is add another R at the end for repeat. I like to just keep it simple with 3 R's: buy, renovate, rent, refinance. So what we're going to do is I'm going to show a video on each of these, starting today with the purchase. I want to make sure we get down to basics and understand exactly how to get the property on your books so that this entire strategy can be played out within QuickBooks Online. All right, so recording the purchase, what are we going to do here? First of all, we got to check our chart of accounts. We have to make sure that we have a place for this purchase to land, making sure we have the right accounts in place. I'm going to show you that today. Ensure that any pre-purchases are accounted for. So your deposits, any kind of insurance that you made a payment for, we want to put those in the right place. Record the transaction, okay? Simple part, could be a little bit complex. We're going to demystify that. These are not difficult transactions. They're a little bit tedious, but I assure you they are not difficult. Match it to your bank account. This might be something you can do as well if you have the bank feeds rolling in. Let's get into it within QuickBooks. First thing, let's check our chart of accounts. So do we have a place for this purchase to land? Okay, and when it comes to a place for it to land, we're typically talking about fixed assets. Okay, so I'm going to usually have something set up like this: real estate owned, with some sub accounts for land, building, closing costs, CapEx. You might have furniture, we have depreciation, we got some other stuff that we probably won't use today. These first 3 or 4 we definitely need: land, building, closing costs, CapEx. Why do we separate out our land and our building? The reason for that is we cannot depreciate our land. Okay, so we need to take our purchase price and separate that out. There's various strategies for that. We'll talk a little bit about it as we get into it. So that is kind of step one. Make sure we have our chart of accounts in the right place. I have my fixed assets. That's good. Another account that you're probably going to want is something like this: an other current asset for purchase deposits, or like escrow, money that is in escrow. Okay, we want that. Also, tax and insurance escrow. So if you're getting a mortgage or if you're getting a loan on a property and that lender is requiring you to retain a tax and insurance escrow account, you're going to want to have an other asset for that as well. We have it, we're ready. Something else you might want is security deposits, because it's often the case when we are buying a property that security deposits are getting transferred over to us. Now, even if this isn't the case on the purchase, you're probably going to need that in the management and the ongoing operations of this property. So having an account makes a lot of sense. Okay, you're also going to need your expense accounts. Now, I always teach that anything directly related to the property is going to be in cost of goods sold. So we're going to add our cost of goods sold, something like Form 8825 from the IRS. I have a full video on your chart of accounts that you can definitely check out if you want to dig into this further. But this is a really good place to start trying to mirror Form 8825 within your books. We're doing that here. All right, so we're kind of ready to go. We have our chart of accounts set up. And you can always add on the fly, but I like to kind of think about it ahead of time so that I'm not adding accounts willy-nilly. All right, I'm going to demonstrate this. I'm going to go way back in time to a balance sheet as of 2018, just because it's kind of empty, and I'm going to record everything on this balance sheet. Really, nothing has happened on this set of books except for I have some cash in the bank that came from me personally, $750,000, okay? First thing is any of those pre-purchase transactions. So what happens when you buy real estate? One of the first things that happens is you submit a deposit to an attorney, okay, or a closing attorney, somebody like that, an escrow account that is going to hold that fund until you actually close on the property. So what do we do with that? Okay, that expense is going to come through your bank feed. You can record it there. You can record it manually, as I'm going to do right here. And a lot of people make the mistake of putting it toward the property itself, but it's not yet. You don't own the property, and therefore we're going to use this other current asset, this purchase deposit. Okay, and we're just going to write here deposit on 122 Buffalo. That's the property I'm going to buy here. Okay, let's just say we have a $1,000 deposit. Okay, I'm going to use class. Now I'm not going to get into specifically class versus customer during this video. I do have a specific video on that. I'm just going to use class to kind of get through this one today. All right, I'm going to save and close that. Okay, so I have now an expense on my books for that deposit, and see where it shows up on my balance sheet right here. It doesn't show up as fixed assets. It doesn't show up as net income. It's still my money. I just don't have control over it. Therefore, it's showing up as an other current asset. Okay, you might have some others. You might buy insurance. You might do anything else like that. Actually, I'm going to change this amount because I'm going to be purchasing a more expensive property. So I'm going to change this to... All right, so I've got that. That's great. Now, let's enter the actual purchase. And to do this, I'm going to pull up a HUD. Now I'm going to do this in two ways. I'm going to do a cash purchase and I'm going to do a finance purchase. So here I have a cash purchase. Let's take a little bit of a look at this. So I'm going to be purchasing the property for $650,000. I've got $6,400 in settlement charges. I'll take a look at that in a second. I've got some taxes that I owe here. City taxes, county taxes, prorated rent. Okay, so this assumes that this property is already rented out. So that is my total that is due from me. Now I have that deposit, and that's where it shows up right there, $20,000 deposit. So that's cool. And then I have some money that's due to me. So meaning on the other end of it, the current seller owes me some taxes and the security deposits as we spoke about. Now this $6,400 takes shape usually on this page 2 with a bunch of stuff here. What's important is that we understand which of these expenses is deductible in year 1, like the first year I own this property, and what will be capitalized. Usually a closing cost that is not related to financing, meaning interest origination charges, will be put on the balance sheet, put on your basis, which is what these items are here. So that's what I'm going to do. And now we're going to add this transaction. And every time I'm adding the purchase of property, I'm going to use a journal entry. It's a really important transaction, and I think a journal entry is a great best practice to ensure that we are getting everything we need from the transaction. So right here, I'm going to start adding everything. First is land and building. I'm going to separate out my land and my building as we discussed. Now, again, that strategy is going to be up to you and your tax professional. For now, I'm just going to say that the land is worth $50,000 and the building's worth $600. I'm also going to indicate those closing costs, so $6,400. Now, I've looked at all those and those all belong in closing costs. I'm not going to deduct any. I'm going to put those all as one line. You could separate them out line by line. In fact, I probably used to do that more than not because it just seemed like a good idea to like list it all out. But for time's sake, I'm just going to list it all as one line, just put closing costs. All right, now I am tracking by business by class. Again, we're not going to go too crazy into that technique right now, but I am going to indicate both a class and a business for this purchase here. Land, building, closing costs, great. Now I have these items here. So I have some taxes. So what do we do with taxes? This is property tax, and these are items that I owe, so I'm going to debit them. $225.45. And really anything on this front half here is going to be debited. So this is city tax. Now I have another property tax. Now some people will add a separate account for county tax versus city tax versus whatever other kind of tax. I honestly don't think it's that valuable. I'll just put it in the description here. It could be, it's up to you. Prorated rent, that's actually rental income. So that's a income right there. And I owe that, so I'm gonna debit that again. I'm gonna follow up with my class. And what I have now is a total of my debits, $662,207.92, which exactly matches what's showing up on the HUD. So I am in good shape. That's kind of your check there. All right, I'm just gonna get rid of these items here. Oh, this is county tax. So it's prorated rent. Okay, now here's a quick tip. Anytime you're working on these transactions, they can be really long journal entries. And as you know, I can't save this because my debits don't equal my credits. So what I'll do, a little trick, is use any other kind of account, like opening balance equity or something. Let that credit fall in there and just give it a quick save. All right, and the benefit of this is that if you mess things up, if you lose internet, if something crazy happens, you're still going to have your transaction. Now I've saved it, I can get rid of that line and continue working. So now I'm going to be doing a bunch of my credits. And so here I have a deposit that I made. All right, now that came from the purchase deposit account. So I'm just gonna use that purchase deposits, do 20,000. They already have that, okay? So I don't have to come to the table with that again. All right, so my purchase deposit account has a balance of 20,000. Me crediting it 20,000 will bring it to zero at the closing of this purchase. I don't have any loans on this transaction yet. I have some taxes. Let's put those in. So property taxes. All right, so property taxes there, I got $245.45. I could combine these two, but let's just separate them out. $2245.27. And then I have security deposit, the last one there, which is $2,500. And those are all credits. And so we're doing well here. Here's my $24,990. That should match the total paid by or for. Excellent. And then the last thing we do is cash due at closing. And this is kind of like the magical moment where we enter our bank account from which the funds came. This is the money we brought to closing, our JMB checking account. That credit, that $637,217.20, should exactly match the bottom of the HUD, which is happening here. Now, a lot of us will sometimes bring our personal funds to the closing table. If that's the case, that's okay. What we're gonna do then is do owner's equity, okay? Or it's probably a combination of the two. So contributions would be an example of this. Okay, so it could be that contribution, and then you make up the rest with your checking account. This, we're just gonna say it all comes from the checking account. All right, we're in good shape. Let's save and close this, see how it impacts our balance date. So there's my net cash remaining. Notice my purchase deposits went to 0. I've populated this balance sheet with $50,000 in land, in building, closing costs, a total basis of $656,400. I've got my security deposits here, and I have a negative net income because some of that tax stuff that happened, right? I owed some taxes, I made some rent, etc. All right, notice I don't have any loans on the books yet. We're gonna deal with that next, all right? Simple cash purchase so far. Let's do a finance purchase. With a finance purchase, you got some other stuff to think about. Here's my finance purchase, and really the top half of it's usually the same. We've got principal on new loans. That's different here. We have a new loan we have to deal with, and we have construction escrow. And the other thing is you're gonna have a lot more closing costs. Now, I use that term closing costs, but they're not all going to be attributed to that closing cost category because, as I mentioned, anything that's directly related to the loan, origination charge, daily interest, in this case, we have some tax and insurance escrow stuff, that will not be tracked to closing costs. I'll show you how we do that. So let's get into this transaction. Let's make an edit on it, and we'll see exactly how things change a little bit. All right, so I'm gonna drill into this transaction, and we're just gonna make some adjustments to it. So the first thing I'm gonna do is I'm gonna put in the $785,000 loan. The cash at closing was different too, so I'm gonna get rid of that. And I'm gonna do this loan. And this is going to be, let's say it's from a hard money lender. So I'm just gonna do private/hard money loans, $785,000. And I have that debit up here too, the construction escrow. So what's happening is the bank, or in this case, the hard money lender, is providing to me funds to actually do construction as well. And they're withholding $175,000 of that. So they're loaning me $185,000, but they're withholding $175,000. All right. Now, also my settlement charges have changed. One thing I like to do, you're gonna see me do it here, is I'm gonna click and drag this up. I kind of like having a lot of my debits in the same place. So I have these settlement charges here. So I have my origination fee, I have my daily interest. These are actually going to be deducted. So I'm gonna do my interest, cost of goods sold. I'm going to debit $23,550. This is an origination charge. Okay, these are points, right? Now, some folks would like to have a separate account for that. That's fine if you like to. I'm gonna keep mine as interest typically. We also have this daily interest right here, the $774. So that's also interest. Again, you could combine them if you want. I'm gonna keep them separate here, $774.25. Daily interest. All right. And then we have this stuff down here. So this is escrow stuff. All right, so this lender is requiring me to hold a balance for homeowners insurance and for taxes. And so what happens on day 0 is these aren't expenses yet. Instead, they go into a tax and insurance escrow account, which is an other current asset. And we just fund it. And then we continue to fund to it as we make payments. I'm gonna show you that in the next video on how we actually renovate and track our expenses. Okay, and basically that escrow account will go up as we make every single payment, tax and insurance escrow, and it will go down when the lender makes a payment on our behalf for taxes or insurance. All right, so there's that 2,000 right there, 122 Buffalo. And again, I like to move all these up, and we can do another check on like our debits and our credits matching. Do they match is my question. And let's see, so I got 864,012, perfect. And then my credits here, 809,990, awesome. And then the last thing we do is cash at closing. And we should have ourselves a match there, 54,021, Beautiful. Okay, now notice I did this entire transaction kind of manually, right? I did not go to the bank feed yet. I'm going to show you that in a second, but basically I want you to do this manually so that we can ensure that we get all the detail. It's not really sufficient to just go to the bank feed. That being said, we can still match it to the bank feed. Let's just see what it looks like on the balance sheet first. So, by the way, I have way more checking balance because I didn't come out of pocket with as much. There's my construction escrow. There's my tax and insurance escrow. My purchase deposit's still zero. Security deposit's there. There's my private money loans. And then my net income is way more negative because of all those origination charges. So they're going to show up right here, interest and property taxes. Now, talk to your tax professional on whether it makes sense to add this kind of stuff to your basis. But typically, if we are given the option, we're going to want to deduct it in the year that it was incurred. So take that option if we have it, okay? So that's pretty awesome. We got everything in there. And if we go to, let me just see if this works. If I go to my bank transaction, I got this thing hanging out here. The date is way off, but if I go to find a match, I'm just going to put in dates for 2018. And there, yeah, right here, I can match it. Okay, now yours will probably automatically match because the dates will be more accurate, but I can match that right here. Now that transaction is going to show up as something that I can, let me just click on the journal entry. So now that journal entry is going to have an online banking match, which is awesome. It's like magical, right? All right, so that is how we enter the purchase for our BRRR property. And what we're going to do from here is we're going to actually renovate the property. We're going to manage the day-to-day financials of it. Okay, so all the expenses that come through, the renovation of it, and we're going to prep this thing for renting it out and actually getting tenants into it as well. So we're going to handle the B, we're going to handle the first R in the next video. Let me know what questions you have. Subscribe to this channel so you get updates. We're going to post the next one very, very soon. All right, and I want to hear your feedback. What are you missing from this? What was confusing? Let's get that answered before we move on to the next one. As always, check out all the free resources available at incomedigs.com, and I will see you on the next video.